There are a lot of so-called investors who dabble in the stock market on a regular basis. They trade small, but they trade often. And the dangerous part is that when their trades are not successful, they retain those shares and call them investments. They are actually now waiting and hoping that the prices of these shares go up so that they can get rid of them. There are obvious differences in trading and investing, and this video attempts to point them out. Trading basically means it's an intraday transaction. So I buy in the morning in the hopes that the share price will go up and I can sell it off in the afternoon for a profit. Or maybe sell in the morning hoping that the share price goes down and buy back in the afternoon at a profit. So this is basically, these trades are basically based on tips that are received, and the biggest source of tips are the stockbrokers themselves. Now they would encourage this because the more you trade, the more brokerage they earn. Then there are a lot of chat forums, and there are, I believe there are certain companies who are now professionally giving trading tips. Then there are the chartists who do technical analysis and they predict the price movements. But essentially traders are short term and the profits are small. I mean, to have a successful trade, this is what it should be. Traders require a lot of discipline. They have to play by the rules laid down in advance. They are actually self-made rules, of course. So the rules are basically about strict stop losses, profit booking at specific intervals, and professional traders who have to be successful basically have to adhere to these rules. Now we come to the pretender, the so-called investors, but who are actually trading. They, as I said earlier, if there is a intraday loss, they would not sell at a loss. They would retain those shares and call it investment and hope that someday the price of that stock will go up and they'll be able to get rid of it at a profit. This is not investing at all. Investments entail a lot of research. Researching a company means meeting its top management, visiting the factories, talking to workers to get a sense of how the business is going. Of course, it also means analyzing the balance sheets. This is the work of a professional analyst. And after doing all that due diligence, the analyst may give a buy recommendation for that particular stock. That is not the end of the story. The stock needs to be tracked, the company needs to be tracked, and there would come a time when it would be appropriate to exit that stock. This is about now one stock. But a good portfolio is a diversified portfolio. So you have to have a number of such stocks from different industries to manage the risk of volatility of a particular stock. So that the volatility is less when it's a diversified portfolio. Then investments need to be long term. So when I say long term, it's not months, it's years, sometimes it's decades. This is the only way wealth creation can happen. In conclusion, in my 31 years of being in the stock market, I haven't come across any person who has made money on trading and taken it home. If you happen to encounter success in your trades, consider it to be more of a luck than your acumen. I'm Yogin Sabnis and you are watching the VSK YouTube channel. Please subscribe for regular updates. Thank you for watching.